Welcome. My name is Sasha Moore, and we're here today at the Finance 15 webinar. I love these webinars that we do with Aquamore because it's a 15-minute deep dive on areas which are contentious, interesting, complex, and so on and so forth. So today's deep dive is going to focus on all of the above, the very topical and contentious area of property price increases versus valuation prices coming down and why there's that mismatch. So in this session, we'll be speaking with Matthew Porch at Aquamore to get his insights into why there's often a mismatch between the two. Welcome, Matt.
Thanks, Ash. Thanks for having me.
So specifically what we're going to be covering today is factors driving property prices, why valuations are more conservative by comparison, what affects the lending criteria and why this doesn't necessarily correlate with the market, how this affects brokers and their clients, and what to expect for the upcoming financial year. We love questions. Time permitting, we'll hopefully get time to go through a few, so please be sure to use the chat function and we'll get through them at the end of this session. So let's get cracking. Matt, in the hot seat. So there's commonly a mismatch between property price increases and valuations. So let's start with property prices and why they continue to increase.
Yeah, so price or value, if you will, is determined by supply and demand. That's basic market functions for the cost of anything, to be honest. That supply demand push and pull, if you like. That's generally what dictates the very large majority of property prices. You can see that with, if you look at Sydney, for example, the eastern suburbs continue to have an increase in property prices based on the fact that, you know, everybody wants to live there, right? So that supply and demand continues to drive property prices. Net migration into Australia has been at record high levels. These people need places to live. So, you know, in effect, the supply and demand chain is dictating the fact that the property prices still continue to increase.
So I think, would you say that property prices would then be sort of quite localized in terms of that supply demand? So you can't actually apply a generic principle to that?
To an extent, yeah, to an extent. As I said, the record numbers of people coming to Australia, which I think the government is trying to work on at the moment, that's driving quite a lot of it. There is a severe undersupply of livable residential properties, and again, that's helping to continue pushing the price up, which, contrary to interest rates going up, should traditionally help cool the property market. To an extent, it kind of has, but yeah, it still continues to go up, which is against what people would be expecting at the moment. So,
no, indeed. Well, let's then talk conversely why valuations are more conservative by comparison.
Yeah, so we probably need to start with, you know, what property valuation actually does. A property valuer is to issue you a report to determine the value of, or the price that you can get for that asset under certain conditions. So you do get a lot of emotional buyers, you get a lot of emotional borrowers who think that their property is worth more by default. They've got a better view, they've got a bit bigger living room. You know, we could talk all day around why people think their property is worth more. And to be completely honest, a lot of that is just emotional sentiment, emotional connection to that asset. They've lived in their property for X amount of years, they've had a lot of memories, etc., etc. All of that subconsciously plays into why they believe that their property is worth more than their next door neighbour, for example. But the valuer's job is to come to an independent conclusion around what that asset is worth. Should it be sold, or in the event that it needs to be sold, for a lender to retrieve their funds. As a lender, you do have to go through quite a lot of stages to have property valuers trust your judgment when you put money out the door. There are a lot of lenders that are pure asset-based lenders. We tend to stay away from that term. Yes, the collateral is very important, but yeah, the valuer's job is to determine what the value of that asset is in the event that it needs to be sold. So by that very definition, and by the API's definition, the Australian Property Institute, there will be a mismatch in what people think the property is worth and what the actual value of the property is.
Okay, so establishing that property prices and valuations aren't an apple for apple comparison. From a lender's perspective, can you talk through the lending criteria and again why that doesn't necessarily correlate exactly with the market?
Yeah, so again, as a lender, well, I mean, using Aquamore as an example, we look at the holistic approach of the client. We don't look at solely the asset on its merit. We look at everything in conjunction with the application that the client has made. And that's what property valuers want to hear from a lender, is that you're not just relying on they've given you $1 million valuation, do your calculations. You have to look at the entire picture as a lender. So again, in that very nature, property valuations are likely to be, again, a little less than what people believe the property is worth. Now, in residential property, for example, a contract of sale, I'd say 9 times out of 10, a contract of sale will stack up with a valuation. The contract of sale is a willing purchaser and a willing seller in a normal environment more often than not. And that in itself drives the value. So if you've got a contract of sale at $1 million for a residential property in a standard location, 9 times out of 10, the valuer is going to say, well, that's a value, that's a driver of value in itself. Where things get speculative is clients are looking to leverage up against existing assets and they believe that it's worth more than what it actually is.
So I know we'll talk to that in a minute, but actually, I love going off piste. So with that understanding, what would you suggest are ways that brokers can have this type of conversation with their clients, where as you say, there is that emotional connection or not correlation with what they're being told versus what's being presented on paper? So what could you suggest in that situation?
Yeah, look, it's a difficult job, being a broker dealing with some of the borrowers that are emotionally invested in what they believe their asset is worth. My advice is just to let the experts do their job, and the experts are these property valuers. The people that we've got on panel are some of the largest and most well-respected valuers in the country. Let them do their job. They're the expert. Ultimately, it's their PI insurance that's on the line. They all have to be adequately insured and adequately experienced in order to be issuing these reports. There are times when they can get it wrong, and myself, I wouldn't like to be a valuer. I think it'd be a very, very difficult job. You can't make everybody happy. You can just do what you're instructed to do. But my advice to brokers is just let the lender and the valuer do their thing. I know a lot of brokers like to take control of the valuation process. I'd strongly recommend against that, because if you engage the lender is the client of the valuer. There's a tri-party agreement between the 3 parties: the borrower, the valuer, and the lender. Let them do their thing. Get valuations done up front through your lender, and that just keeps everybody in the loop. It keeps it all very transparent. If you try and control the valuation process, things can get a little bit sticky and can get a little bit messy in the event of default. So yeah, just as I said, engage your lender, let them engage the valuer, and whatever the result is returned, you just have to work on that.
So I guess it's also on that point, just managing client expectations, and that it is what it is, and also just managing that sort of discretionary expectation that the valuer, as you say, they're doing their job, so there's not that discretion, there's not that push for it to be one way or the other.
Yeah.
We've talked about residential properties. We might talk about commercial property in comparison, and the cap of net income approach about that.
Yeah, so traditionally, commercial properties are valued using what's called capitalization of net income approach as the first methodology. Cap of net income approach basically puts a multiplier on the lease agreement that the commercial property has. The stronger the lease agreement, traditionally, the stronger the value that will get returned. What valuers are conscious of, however, is lease agreements that are over market value. So if they believe that there's a tenant in there that's overpaying the odds in regards to the market, they will reflect that in their valuation report. So we have had a few borrowers that try to be a little creative. They'll put a non-arm's length lease agreement in place where they've jacked up the rent, 3 or 4 times in order to return a better result. Any valuer worth their salt will come back and say, look, that's not worth the rent that they're paying. So price and yield have got an inverse relationship. So the cap and net income approach will use a yield. Metro areas, you're probably looking somewhere between 5 and 7%, 5 to 7.5 maybe. And regional areas, you're looking at 7.5 to 10. So your yield is higher in regional locations. The reason being is that the risk is a bit higher. There's a shallower market. There's less people in regional areas. There's less chance of getting that property let out. You also need to consider the risk-free rate as well, which is somewhere around about the BBSW rate. Term deposits are paying 5.5%. If your yield is less than 5.5, 5%, the valuer is asking themselves the question, why would you invest your money into an asset that's yielding less than 5% when you can chuck the money in a term deposit, which is effectively risk-free for 5.5? Why bother going through all the rigmarole of purchasing a commercial property and putting a tenant in there for a yield of less than 5%? And that's the question that our credit department would ask as well.
Okay, thank you. We've actually had quite a few questions come in, and they're in a similar vein, which I'll surmise by a frustration directed towards valuers. So on that note, and I might just backtrack to one of the previous comments that you were talking about before, Matt, if you could just provide a bit more context in why do valuers do conservative valuations, and why, similar question, why they're not genuinely and actually reflecting the market value. So why there is that gap, if we can maybe sort of drill into that a bit more.
Yeah, I mean, if you instruct a valuer to do an asset valuation, there is a chance that an asset valuation will return a higher result than a valuation for first mortgage purposes. The reason being that first mortgage purposes could return a lesser result is in lending, the client needs to get themselves out of that debt effectively. They need to extinguish that debt with the lender at some point. Now, to use Aquamore and private lending as an example, a lot of what extinguishes the debt is a refinance. If your property has been valued too high, the client can't get out. If they're at 75% leverage and the valuation's too high, if you're going to refinance into a bank, even at 80%, and that property value has went too high, the client's stuck. You then need to make a hard decision and tell them you're stuck, you're going to have to sell this property. And again, if it's too high, who's to say that the sale price is going to extinguish your debt? So again, it ties into, I'd hate to be a property valuer. Again, you're trying to determine what a value is at a certain point in the future. You don't know what that point is going to be. You need to make some speculative judgments. You need to make some speculative calls. And that's why they tend to err on the side of caution. And from a lender's perspective, we don't like to see valuations come in well short of what we believe it's worth. But if I had to pick between the two, I'd rather it came in less than came in higher, because it saves everybody the heartache, and that's brokers included. We have had a couple of troublesome clients where, the brokers ended up having to walk away because they can't get the client out. And that's a situation that nobody wants to find themselves in.
Okay, thank you. Well, time just seems to vanish. So we'll just, we won't be able to get through more questions at the moment, but let's just have a bit of a forecast for the upcoming financial year. Matt, what are your thoughts about the new financial year?
In regards to property prices, look, I think they'll be steady. Again, it's crystal ball in regards to interest rates. Do we know where interest rates are going to go? If I was a betting man, I would say there's maybe still one rate rise in there based on inflationary figures. What will that do to property prices? It should steady them out if everything else is to be believed. You've still got, as I said, inflationary pressures, which is stopping people from realizing the true value of their money at this moment in time. So have people overpaid for property in the past? Perhaps. So I would say you're looking at steady prices for the next year.
Yeah, and I'd concur from my very expert opinion that you know, at least the remainder of 2024 is going to be very similar to where we're being right now. Perhaps consumer confidence might start to increase a little bit once, if the rate stabilizes, but I would expect with my broking hat on, it's where we're at now. I don't see materially changing for 2024, but I'm hoping by about Q1 25 that it's starting to see a bit more of an uplift. But yeah, as we've seen, a lot can happen in a very short space. But Matt, I know we could talk about this all day long, but we should wrap for now. Thank you as always for your time, and we look forward to seeing you at the next Finance 15 session.
Thanks, Sasha. Cheers.